We're going to chat about our lead article, The Big Picture for Q3 2022 for the North Star Market Report. And the article really deals with heuristics, which is the brain's kind of subconscious decision-making process and how it leads to biases. And we're specifically relating this to how the market's behaving considering the high levels of inflation at the moment. We delve into anchoring, which is really our brain's tendency to place undue emphasis and make decisions on our past and our experiences as against looking at all facts and factors. We feel the market is priced high, priced for low inflation, priced for strong profitability, priced for low interest rates. And really, what that's telling us is it's priced as if we're going back to our past and not a world of high inflation. So this is important because really, since 1982, most of us that have been operating in the market, and particularly those that have been in the market in the last 10 years, have only really experienced two bull markets. Bull markets during periods of lower inflation, higher earnings growth, high PEs, and high returns compared to history in the market. If we go back prior to 1982, the market had high levels of volatility, a much lower PE. In fact, the bull market that started in 1983 started on a P of 7. High levels of inflation before that, which Volcker, since August 1979, broke the back of that inflation. He pushed interest rates from 11% to 20% due to excessive levels of inflation and brought the economy to its knees for a period of time. But we're not seeing that currently. That's not how the market's pricing current inflation, which is also at extremely high levels. It's just assuming that things go back to normal. And we think this is deeply embedded in heuristics and the fact that most market participants are just not used to the kind of environment that operated before 1983. So we also speak in the article around certain aberrations. For example, the S&P earnings yield, which has traditionally always traded at a higher level than inflation, is currently substantially lower than inflation, which implies that investors are getting negative returns relative to inflation. Also, we look specifically at the Fed funds rate compared to history and just how far the Fed is behind inflation. So really there's a lot of embedded risk in the market currently. It's not priced for high inflation on a more sustainable basis. We have no idea what inflation will be in the years ahead, but we certainly can tell you the market is not priced for inflation levels like we saw in the 1970s.